Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, traders. Today, we're diving deep into a fascinating stock that has popped up on our hard-to-borrow screener, SPHL, or Springview Holdings Limited. We're going to break down why this stock is attracting such high fees for short sellers, what it could mean, and what key data points you absolutely need to know. Let's start with an introduction to Springview Holdings Limited. Show SPHL logo/stock chart. SPHL operates in the consumer cyclical sector, specifically within residential construction. Based in Singapore, this company, through its subsidiary, designs and constructs both residential and commercial buildings. It tackles new construction, reconstruction, and even significant additions and alterations. Springview Holdings also offers general contracting services, including renovation and design consultation. It's a relatively small company with a market cap of just $7.02 million. Looking at recent price action, SPHL was down 2.15% today, but it's seen some upward momentum recently, gaining 7.43% over the last 5 days and a significant 21.37% over the last 30 days. Interestingly, today's volume was quite low at 50,200 shares, a fraction of its 30-day average volume of 2,087,156 shares. Highlight volume difference on chart. What is cost to borrow and why it matters? So, why are we talking about SPHL today? It all comes down to something called the cost to borrow, or CTB. Show cost to borrow text on screen. In simple terms, when you want to short a stock, you first have to borrow shares. The cost to borrow is the annualized fee that short sellers pay to borrow those shares. It's essentially an interest rate. A high CTB indicates strong demand from short sellers to borrow the stock, or, more importantly for our discussion, a very limited supply of shares available to be borrowed. When you see a CTB rate over 100%, it means that if you held that short position for a full year, the fees alone would exceed the initial value of the shares you borrowed. This can be a major red flag for short sellers. Why this stock is hard to borrow right now. Now, let's look at SPHL's numbers. Show data points on screen. The current annualized cost to borrow for Springview Holdings Limited is an eye-popping 639.6%. Highlight 639.6%. To put that in perspective, that's not just high, it's exceptionally high. What's more, this CTB fee has shown significant momentum, increasing by 158 percentage points over just the last 5 trading days. This rapid escalation tells us that the cost of maintaining a short position in SPHL is skyrocketing. Adding to the squeeze potential, there are only about 1,000 shares currently available to borrow for SPHL. Show 1,000 shares available data point. With an estimated float of 1.2 million shares, 1,000 shares is an incredibly tight supply. Our internal composite squeeze score for SPHL, which factors in CTB level, CTB momentum, shrinking borrow supply, float size, and other dynamics, currently sits at 40.2 out of 100. This combination of extremely high and rapidly increasing borrow fees coupled with a severely restricted supply of shares is precisely why SPHL has landed on our hard-to-borrow screener. Squeeze mechanics explained. So, what happens when a stock becomes hard to borrow with such high fees? This is where the concept of a short squeeze comes in. Show short squeeze graphic. Imagine short sellers are in a crowded room, and the music is playing. When the music stops and the price of the stock starts to rise unexpectedly, these short sellers, who profit from a declining stock price, suddenly face mounting losses. Simultaneously, the exorbitant cost to borrow fees continue to erode their profits, or even accelerate their losses. With only 1,000 shares available to borrow for SPHL, it means very few new short positions can be opened. If the stock price begins to climb, short sellers might be forced to cover their positions, meaning they have to buy back the shares they initially borrowed to return them. When many short sellers are forced to buy back shares at the same time, it creates a cascade of buying pressure, driving the price even higher. That's the essence of a short squeeze. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to maintain their positions. Dilution risk check. Before getting too excited about squeeze potential, we always run a dilution risk check. Show dilution risk text. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares and makes it easier for short sellers to find shares to cover, effectively offsetting or even negating any short squeeze thesis, even with high borrow fees. For our SPHL, we found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. Furthermore, there have been no recent reverse splits for SPHL in our look-back window. This is a positive sign for any potential squeeze thesis, as it removes a major headwind that could undermine upward price movement. Once again, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For SPHL, if you're tracking the stock, here's what to watch for. Show key metrics on screen. First, monitor the cost to borrow. Will it continue to climb, or will it start to ease? Second, keep an eye on the shares available to borrow. If that already tiny number of 1,000 shares shrinks even further, it indicates increasing pressure. Third, watch the volume. Today's volume of 50,200 shares is significantly lower than its 30-day average. A true short squeeze often begins with a dramatic increase in trading volume as short sellers rush to cover their positions, pushing the price higher. Look for sustained price appreciation on increasing volume. Finally, observe the overall price action. While our SPHL has seen positive momentum over the last month, a strong upward break from its current levels, especially with increased volume, would be a key indicator. So, there you have it, Springview Holdings Limited, SPHL, a stock with an exceptionally high and rapidly increasing cost to borrow of 639.6% and a tiny supply of only 1,000 shares available to borrow. This unique combination makes it a prime candidate for our hard-to-borrow watchlist. While the ingredients for a short squeeze are certainly present, remember that high CTB alone doesn't guarantee one. Always conduct your own thorough due diligence. If you found this breakdown of SPHL insightful, please hit that like button, subscribe for more deep dives into hard-to-borrow stocks, and let us know in the comments what stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.